What do you make about some of the things that we're talking about here in the chip market? The idea that the U.S. government may look to take an equity stake. Chip investors, they don't seem to be very confident or very positive about that move. We're seeing chip stocks move a bit lower on that story.
I'd take a step back from the sector specifics of this, and I'd think about more broadly how, as an analyst, we view companies such as those in China, which do have a long history of government involvement. And we score them lower on our governance criteria because of that. And I think we need to make sure that we're thinking about this consistently, right? So as international investors, we look at the free markets of the Western world, and we think that's a positive. We think the fact that private markets and private companies, although publicly listed, are allowed to operate within the confines of that free market and do make decisions based on what's best for their commercial outcomes and their client outcomes. Entering a third player into that in a form of a government is mostly seen as a negative when we're assessing emerging markets. And so we need to think about if this starts to become the norm in developed markets, not least the largest developed market in the world, are we consistently applying those criteria and saying, actually, this would hamper the company's abilities to innovate, as your previous guest said?
All right, we're also looking at some of the rotation in the market. We were hitting it just a short time ago. Things like the Mag 7, some other high valuation tech names like the Arc Innovation ETF, seeing a kind of change in momentum. Palantir is another company a lot of people are highlighting, seeing a significant change in momentum, actually hitting correction territory. What do you make in this shift of momentum, and how much is really, I guess, riding on Jay Powell's speech on Friday and the idea of a 25 basis point cut, or at least signaling one, compared to a 50 basis point cut?
I think there's two things at play here. We always see this whenever a market becomes extremely concentrated or narrow, where we've seen just a few names, really drive a broader performance. That as, valuations get toppy, people take gains. You're really looking at some pretty extraordinary returns over the last kind of 5 years in some of these names, despite the rotation that we saw earlier in the year. And so actually some of this might just be people taking money off the table as we face broader geopolitical uncertainty. Tariffs is still a story that's playing out. Now you have the Ukraine-Russia war, the US involvement. So some of it, I think, is just simply gains being taken off the table. And some of it very much is about, okay, what is, the central bank policy going to be in the US and indeed over here across the pond? We've just had an inflation print that came up higher than the month before. I'd say on both sides of the pond, we're looking at a higher for longer. Despite the pressures from the White House, Jay Powell is staying steadfast to his course, which is he wants to see much more compelling data before he makes considerable cuts. We still think our base case for the Fed is a cut in September, but actually we think no further moves for the next 3 to 6 months after that, and that will hurt these high growth names.
Emma, I want to dig into what you just said. You said it's just profit taking, but in all fairness, people take profits when they expect things to change when it comes to momentum, when they expect the markets to either pause or make a turn to the downside. So do you really believe that, or do you think investors really believe that Jay Powell is going to be more hawkish than we previously thought he would be, and that the cuts are desperately needed to keep the rally going? I mean, to kind of just clarify, when you say just profit taking, that kind of just makes it seem like it doesn't indicate sentiment and a change in sentiment after a very bullish year.
I think the two things are intertwined. So it's profit taking because of the uncertainty and because of the central bank policy that we're expecting. We still don't think that the tariff story is fully played out. Yes, we might have had some resolutions of where those levels are, and yes, we have started to see the receipts come through for the U.S. economy, which is a positive. But in terms of the impact on the wider market, what it means in terms of prices being passed on to consumers and how that consumer is squeezed, and therefore how that plays back into the economy, we still don't have resolution. Also, the fact that the US has started to be involved in the kind of Russia-Ukraine war and what that means for geopolitical uncertainty. I wouldn't say that there is a benign global environment right now which would support kind of lower interest rates and an ongoing rally in equities. If we're looking at kind of what our clients are telling us right now, they're nervous. They're nervous about the geopolitical landscape. They're nervous about equities. We're not saying that we are going to be kind of particularly negative in terms of our positioning on the US, but it's definitely a neutral. And we think actually the rest of the global market potentially benefits from a best of the rest trade. So if you're looking to allocate money right now, the US looks toppy and it looks uncertain. So therefore actually you're looking across the UK, you're looking at Europe and thinking, On a
Okay.
kind of contextual basis, that looks more attractive.
Emma, one thing you're saying the UK looks attractive, Europe looks more attractive. When you look at gilts, the upside move in yields on gilts has been very dramatic. So what does that signal? If you think investors think the UK and Europe are more attractive, why are we seeing yields over on the continent move higher?
I think we need to decouple the economy and the equity market, right? Because 75% of revenues for FTSE 100 are international. When you get an economic crash, obviously you see that correlation, lack of correlation disappear. But with the equity market, what we're seeing is a couple of things. At the best of the rest trade, as I said, if you've got dry powder right now in the US and you already have, portfolio proportions of kind of 65% market neutral, you're looking at actually, does the UK look attractive? It does on a valuation basis, despite the fact that we had FTSE 100 topping near all-time highs intraday yesterday. Actually, there are still some really compelling businesses with kind of very low debt levels, kicking off really nice yields in that market at the moment. So, I think it's the best of the rest trade. But on an economic basis, there are some concerns. We've had weak jobs data, as you have had in the US. We've had inflation coming in at 3.8 yesterday. And actually, the expectation for September is that rises again to 4%.
Okay.
We had a rate cut last week, but they were very much divided. It was 4 versus 5, which makes people think actually.
Right. And everybody here in the US thinks rate cuts are going to solve the yield situation here, or at least previously thought when yields move higher.